in multifamily, income is always double what your expenses are. So as rates are falling or as treasuries are falling, the local banks haven't been as fast to drop.
That's such a who, not how solution. Because you're like, I'm not in the laundromat business, but we can still get some profit. Well, thank you for coming on the podcast, Candace Pilgrim. You have been in the multifamily space for a long time. You work with a team. And when I was like wanting to get someone in this multifamily space, you were number one on my list. So thank you so much for taking the time to come hang out on Beyond Wealth. So appreciate it.
Thanks so much for having me. I'm excited.
Yeah. So we're going to dive into all things, multifamily. You've been in the space a long time. Just give me an overview of your experience, the team you work with, your company, and kind of where you guys have positioned yourself in the last couple of years.
Yeah, absolutely. So I guess I'll go back to when I first arrived in Birmingham, which is where I'm located now. By the way, love that this is a Birmingham-specific podcast. This is super cool. First one I've done that's actually local to my hometown. Well, it's not my hometown, but I feel like it is. So I arrived in Birmingham in 2012. I was actually pursuing a PhD in immunology at the time at UAB. So that's what brought me here.
Humble brag. She's just dropped the mic.
So then let me go a step further. I did not finish the PhD. Okay, I was a PhD dropout. So let's be clear here.
Yeah.
But yeah, so I ended up changing directions away from that program. Actually started an electronics wholesale business with my husband. So we did that for about 8 solid years, did really well with it. So what kind of led me to multifamily was we were looking for a place to invest capital that we had accrued from that business that we no longer needed to reinvest in that business.
Oh, okay. Very cool.
So I was looking at different types of, asset classes, different types of investments. I didn't like the stock market. I couldn't control it. I'm very type A personality. If you didn't know that already about me, you will. So that's really what led me to multifamily. So I started passively investing first with other operators and kind of peeking behind the curtain, so to speak. We did a couple of single family rentals, BRRRR strategy stuff. Some private lending, debt funds. I did some just various investing first, and then I honed in on multifamily, decided by 2018 I wanted to be 100% active multifamily operator. That was my passion. That was my focus at that point in time. So went down that path, really just gave it my all and poured, every hour of my day into learning that space inside and out, learning all the people in the space, learning how, all the roles in the space and how it works. So fast forward a bit, now my team is made up of 4. So it's myself and Jeremy Porto, Stuart Dukeman, and Rich Trepanyer. The 4 of us, I'm the only one local to Birmingham, but the 4 of us almost exclusively pursue assets in Alabama. We're also looking a little bit in Mississippi now. But everything we own currently is in Alabama. We've closed a total of 17 assets to date, 3 of which we've sold. So we still have 14 in our portfolio in Alabama. So total unit count in our current portfolio that we're holding is 554.
Wow.
So that's where we're at today and looking to continue growing with those guys because they're awesome partners.
Yeah. So just for, the layman, 17 acquisition, now you're down to 14 property like complexes, but
right.
Those could mean multiple units, correct?
Right. So the 14 make up 554 units that
right.
we're holding today. Yeah.
Yeah. Mm-hmm. And so in that space, you just say how many doors you got, and you say this many doors. So that's incredible. So when did your team kind of form and start to really go into acquisition mode and stuff? How long has that been?
Yeah, so all 4 of us have previous real estate experience, and I did have a couple of assets that I had acquired prior to joining those guys with Astra Equity. But it was 2020 that we really started looking at deals together. Not that we ever thought we would exclusively work together and co-brand and all of that. But at first, in 2020, we started JVing deals together. So the 4 of us would come in with our 4 separate companies, joint venture a deal. And through that process, after the 3rd one we JV'd, we discovered each of our strengths, where we fit in within the company, what role each of us wanted to take on. So after the 3rd one, we were like, this is just like, as my husband says, it's kind of corny, but he always calls us lightning in a bottle, which is a little bit of where Astra came from, your space, lightning, whatever. It's also a reference to Huntsville, but sidebar.
Yeah.
But yeah, so by 2020, we were working together. But then by January 1st of 2021, we formed Astra Equity.
That's amazing. I love the part of the story of, a lot of times people look for partnerships and sometimes they jump into it too quickly and then they realize this doesn't work or, this is not what we thought it would be. And you stepped into it, in my opinion, in a wiser way of like, let's do temporary partnerships, this JV thing. Mm-hmm. And if it works out, we'll do another one. But there's no long-lasting relationship besides that one partnership of maybe that one purchase of that property. Mm-hmm. And then if things didn't go well, you just wouldn't do repeat business. But obviously, in your case, it did. And it also gave you time to figure out the strengths and weaknesses and how you would blend together. I've heard a lot of people partnering with sometimes people they think they work well with. Well, it turns out they just are very similar.
Yes.
And so they figure out that we're just really good friends, but not good partners. And I think in every good partnership, there should be actually friction because that is a refining and the difference of opinion actually is what makes you stronger. Mm-hmm. So I think that was very wise. I want to step back to your 8 years of experience in a totally different space. But I think one part of our journey always informs the next. Help me understand some of the things you took from building that business into where you're at now with real estate.
Yeah, so I think the biggest thing would be reputation is everything. So in that other business, people did business with my company because of me, because of my husband, because of who we were. Especially the last few years of that business, the profit margins had shrunk so small, and competition was fierce. The first few years, not so much.
Candace was going in matches. She was like boxing people out. It was tough.
Those profit margins were shrinking, and I had to do more and more volume in order to keep the same, net profit.
Yeah.
So the way we were able to accomplish that, why wholesale to us, for $600 for this device when you could go wholesale to this group for $605 for that device or whatever. It was because of the customer service we provided, who we were. They knew they could trust us. So it's really just that reputation we had in that space that allowed us to be successful. So that I feel like that's the biggest thing I've kind of carried over to multifamily. It's the same way. I mean, reputation is huge. And from reputation with brokers, they're not going to bring you deals if you don't have a good reputation in the space. From reputation with partners, and I don't just mean my core partners, but anyone else we work with, investors, and even down to reputation, like property reputation with residents, because turnover is our biggest expense. So you want to keep that property reputation good. And really just doing deals for the right reasons, having the right motives, just being a good person. I feel like I think that's true for any business, but that's one thing that I really carried over. Like I was so successful because I did everything for the right reasons here, so carry that over, and the same has been true for sure. Man,
that's such a good thing. Break apart for me one thing you said about brokers, and I think about, if a broker brings you a deal and you don't close it, and then brings you another deal and you don't close it, and brings you another deal and you don't close it.
There won't be a third deal.
There won't be a third deal. Right.
That's
so
optimistic.
How do you navigate when you walk through a deal and end up not closing it, but still keep that reputation and that conversation going with that broker, knowing that like, hey, we didn't do this deal, but we do close. Mm-hmm. This specific situation didn't work out. Do you do any kind of, not to say that it's like a disaster, but like kind of like helping them keep the relationship or things that you do to say, hey, let me explain why we couldn't get there. So that but bring us the next one and hopefully we can work through these things? Or is there any process to keep that reputation going with the brokerage?
So what we do to prevent even being in that situation would be to ask all the questions up front. So there's kind of two different ways groups go about offering on deals. Some groups, they'll look at the financials, they'll do a high-level underwriting, they'll throw out an LOI. And then they think, well, I'll figure all the rest out during due diligence and just back out if it doesn't work, or retrade the seller if I find something that I didn't know. That's not the way we do things. What we do is we get super detailed pre-LOI before we ever make our offer. We make sure we tour. We make sure we fine-tune line item by line item on the CapEx budget. We make sure we ask all the questions, like, does it have aluminum wiring? What about Fed pack panels? Like every little thing we make sure we know going in. That way, there's very little we could find. And if we do find something that would cause us to back out, it's going to be something that was misrepresented to us, in which case the broker will totally understand.
Man, that's really good. In that due diligence process, do you guys have like a running list of like, because I'm sure first deal, your due diligence is a little more thorough now. There's no way you go through 15, 17 property acquisitions and not refine your process. Is that a document? How do you go through that due diligence pre-process before you even put an LOI in?
Yeah, so we have just kind of a running list in our underwriting model that Jeremy's kind of put together, and he adds to it over time, like deal by deal, of things that we would try to ask or find out beforehand. So, maybe call it pre-due diligence. It's not actually the due diligence period. But what we've also learned with that is maybe it means we lose some deals, because I think at times the seller will be lured in by a high offer from a group that hasn't done all that pre-DD. And then they'll get into DD and then retrade and ask for a lower price. And then sometimes the seller may be like, I'm already this far. I'm just going to take it. I don't want to start over with another group. So I do think that method of handling things may cost us some deals, but it maintains our reputation. And brokers think very highly of us because of that. And it's also a much lower chance of a retrade. Not saying we've never retraded, but when we have, it's been for something, they told us the roof was brand new and we can't get up there during the tour without, getting it pre-approved with liability.
You don't grab a 40-foot ladder and just...
They would be like, show proof of your insurance. That's a liability. So, something like that. If we can't see it, maybe we can't see it, and then we find out the roof is 25 years old, or, just an example. But there's certain things that if it was misrepresented to us, then the brokers totally understand why you would need to retrade. But we just try to make sure we know everything up front going in.
That's really good, because even in the single family space, which I play a lot in with investments and just residential, there are agents that I know that when they send the offer, I'll tell my clients, this is a 50-50, it's going to close, because they just throw out a lot of offers.
Yeah.
It's their method. Mm-hmm. Now, it's a little different. Obviously, they're not underwriting multiple units at millions and millions of dollars. So I get that there's a little bit more just like, hey, get some offers out there for a single family home investment. That said, there's a reputation now that, a few agents have with me that I'm like, hey, just so you know, this is probably, it could not, but this is probably how this deal is going to go. They're going to ask for concessions. They're going to probably try to, like you said, retrade, which, basically my understanding of retrading is basically said, well, I'm going to pay you X, but now during due diligence, we want to pay you less, So that reputation, I'm sure as much as you've lost, you potentially could have gotten because of your reputation. So it's
exactly for every deal we've lost, there's going to be another deal where, say, the seller needs surety of close, like maybe they have debt coming due, they don't have time to start over. Well, that broker is going to think, who do I know will close this if I bring it to them and they can make pricing work? Then they're going to come to Astra Equity because they know we'll close it. So yeah, I agree with you there.
When I make my offers sometimes on some odd flips, I tell the sellers often, I say, I'm never going to be your highest number, but I'm going to be the number that closes.
Yeah, so important.
And so it's because I know what I'm doing, and I do my due diligence before that very reason. So, I think it's got me some opportunities that wouldn't have been there if I hadn't, So that's great. So let's pivot a little bit and talk about you kind of got back into the, capitalization and the improvements and all that kind of stuff, which is a little bit more of your expertise of the management side of things. So talk about your specific role, what you bring to the table, and kind of your area of expertise in this field.
Yeah, so my role within the team is asset management, which differs from property management. Asset management is more the person, or the asset manager is the person who would oversee property management, make sure we're executing our business plans, just make sure we're on target, from everything from how many units we're turning per month versus what we modeled, to how fast are we growing rents, how fast are we pushing renewal rates. So everything, every little line item on the financials, I'm constantly watching and like, how does this compare to what we underwrote and what we're projecting for investors, and how do we need to pivot to make sure we hit it?
So when you talk about rental turns, like turning each unit, do your projections ever match up with actual what's happening, or has that been like a rare case? Because I feel like construction's always a little.
Yeah.
You kind of go into it like you're like, I'm going to build in some margin, and then they still eat up that margin.
Yeah, so it's very rare that it's ever going to hit exactly. We've got a lot of assets that have far exceeded, and then we have 2 assets that are slightly below, and then we have a few that we've only owned for like a year that are hitting exactly, but it's never going to remain that way. There's just too many things that can change that'll either make it go up or down. But overall, now the construction budget, I will not say we've ever hit that exactly. Yeah. But what typically happens though is if we overperform on rents, on income, if we are generating more cash flow than we projected, and we go over budget on construction, this is true for one of our assets, we've actually been able to still exceed return projections for investors on the cash flow side, but use some of that excess on top to then just go towards renovations. So, it's all worked out for us so far on that side. Yeah,
I mean, I would agree that in general, life is becoming more expensive, and that includes rents. Especially if you're putting out a good product. And so, I agree. I have a flip in Hueytown I'm working on right now, and it was a burnout. So we're down to studs, and the initial projections, couple of reasons. I am probably about $25K over on the ARV now than my conservative projection when we started the project, because as the project has kind of broken apart, I'm like, we're going to have new HVAC, like brand new wiring, brand new drywall, kitchens, bathroom. I mean, everything inside those 4 walls is basically going to be brand new. And so effectively, it's like my ARV was probably too conservative, because even though the budget's increased, that budget increase has also made the product quality higher. And thus, I'm probably going to get a higher price. So we'll see. On the podcast, I'll come back in a few months and have to say like, hey, we made it or not, But that is an interesting thing of like, as that life increases, your rents are probably trying to stay with it. Right. Maybe not perfect, but it's still getting you the returns that you want.
Yeah.
So progress, construction kind of happens. What other things do you manage in that process?
So additional roles I have is, Rich Trepanier is actually our construction management partner. So I'm not as heavy into that piece, but there's a lot of overlap with the property operations and the construction management. So I am a part of all of those calls, the construction management calls, and just kind of make sure everything lines up how it should. But in terms of additional roles, I also handle all the distributions for our investors. And I also make sure that we have regular communication with property management. So we have calls set up on a recurring basis to just go through where are we at with delinquency, where are we at with leasing, and what can we do to improve those things. So I'm constantly watching all those KPIs to make sure that we are operating at max efficiency.
When it comes to the construction, I'm assuming your assets vary in class, to a degree. But do you have like a B class set of finishes instead of like, this is the LVP we put in, this is like, and obviously there's going to be variables per the property of like, you got to make small pivots, but you kind of have a package for like, here's our B class, here's our C class finishes. These are standards that we have across the board. It doesn't matter the property. And then also timelines, like our flip timeline needs to stick within a month or 2 weeks or whatever. Or is it per property, based upon per property, and you're kind of always pivoting and there's no standard across the portfolio?
Yeah, we definitely have a standard and consistent finishes because it just makes everything easier from a construction management standpoint. So anything B class or less, and we don't do a lot of C class areas or tenant profiles. We may have a C class property based on age, but we're always trying to bring that to a B. So for the B class or less, what we'll do is black appliance package, faux granite but laminate countertops, and the luxury vinyl plank throughout, and then updated plumbing and electrical fixtures and hardware.
Okay.
But then if we have more of an A-class property, that's when we'd consider, your stainless steel package, granite or quartz. We haven't done any quartz, but that's something we would consider for more
gold handles, nothing but the best.
Yeah, we haven't gone that far. Not quite Matthew Gregory level yet.
Yeah, right.
But no, one thing we do always do, regardless of the class, is luxury vinyl plank flooring. Not only is that something that residents value and we can get a rent premium, but it's just also a no-brainer from a future repairs and maintenance standpoint, because on those unit turns, we don't want to be replacing carpet or sheet vinyl or whatever all the time. It just adds up. So we do that in every deal, no matter what. Now, to answer your question about turn timeline, if it's a moderate rehab, like moderate to heavy, like if we're doing everything from countertops to appliance package to flooring to plumbing, I don't mean like heavy plumbing, but just the trim, the hardware and electrical package, we would normally aim, or this is how we would underwrite, and we usually hit it or exceed it. We would do from move out to move in, so this would include the leasing period, would be 1 month.
That's good.
Yeah, that gives us, 3 weeks or so to make sure we get that renovation done, then a few days for punch, final clean, and we will have tried to have pre-leased that unit to where we time that move in to where there's not too much additional downtime.
So does that mean you always kind of have to have a unit free for like showings, basically, of like, hey, this is floor plan slightly different, but this is kind of how, or do you just kind of show them pictures for the pre-leasing process? Because obviously the unit's you're not walking them through a construction site.
Exactly. Yeah, so we definitely try to get away with just pictures. There's always going to be some prospects that say, I want to see the unit. I don't want to just see pictures.
Yeah.
And it usually works out to where, like, if we have construction going on and we have multiple units being renovated, hopefully there would be at least one unit, even if that one's already leased, there'll be this one that is actually rent ready enough to show.
In transit, yeah. Okay.
To where we can then, that may not be the unit they're getting, but they can at least see the same floor plan.
Yeah.
And usually it's true in multifamily where you're not going to have like a ton of different floor plans of the same unit types. Like if you have a 2-bedroom unit, they're usually all the same floor plan, or maybe there's like 2 different ones, but it's not going to be a huge difference. Do
you see in the units you buy, the bigger properties, there is much variation? Like, there's 2 2s and 3 2s and 1 1s, or is it like for the most part that asset that you buy as a group of, doors, they stick with like 2 variations and that's it? Like, what is the model that you've seen? Is there 3 variations? Like, I would feel like 4 or 5 different plans is like probably architect's nightmare.
Yeah.
They're not doing
a nightmare for us too.
Yeah. It's like everybody is like, they just hated themselves. It's like.
Yeah. So I would say in the larger assets, we typically see somewhere around like 60% 2 bedrooms, 20% 1 bedrooms, 20% 3 bedrooms. So you usually have 1, 2s, and 3s. It's really a wide spectrum, so you'll see some of each end of that spectrum there. But that's kind of what I would say is average. Now, smaller assets like 40 units or less, sometimes you will see like all of them are 2 1s.
It's just, like not even a variation of 2. It's just, we built 2 1s.
You may have half 2 1s and half 1 1s, or all 2 1s. There usually won't be like 1s, 2s, and 3s and as much variation. And this is all speaking in averages. I'm not saying you're not going to find a property that has 10 different floor plans, but it's just not as common.
So we originally met at REI Live a while ago. I introduced myself, loved your talk, and you had shared about kind of increasing the value of the property and how you do that. Deep dive for me on some of the pivots, because when you talked about it, it was actually something I didn't understand, and it was like 30,000 foot view. It helped me, but so from that aspect of someone who doesn't fully understand, like, how do you add value? You buy an asset, yeah, sure, you can fix up a unit, and we understand that makes more rent and that increases. But there were other things that I was surprised about, like charging for internet or different things. So talk through, that's part of your role, is to, once you have the property under, your management, how do we increase the value of it?
Right. So that's actually what really drew me to multifamily. That's why I love commercial versus residential.
She's like, let's go. This is my time.
I love that ability to control where the value goes, like to force that appreciation, not just rely on the market. So, I won't go into multifamily 101 here, but just on high level, like I'm sure and a lot of your listeners probably know, commercial is valued based on NOI divided by cap rate, right? The net operating income divided by the cap rate. We can't control the market cap rate, but what we aim to control is that net operating income. And that also gives us a safety net when the market does correct. Because when the market corrects, if we go into a recession, you'll see cap rates go up. But if we have been able to drive that NOI up at the same or greater pace, then we're not underwater in the property. We still have equity. Of course, we wouldn't sell during a recession anyway, so we'll just wait till it passes and sell, and hopefully still meet our returns. But it's just that ability to drive that value that really, to me, that's what you want to be buying when the market is soft, because you can control where the value goes rather than just relying on the market only. So ways in which we do that, the biggest one is rent. We try to buy properties that are significantly under market rent, either as is, or that as tenants move out, we'll renovate their units and then offer those units at a higher rate for those renovations.
I'm going to stop you right there. So in the assets you have purchased, what percentage have fallen in the need rehab and what have fallen in the rents are just low and it's poor mismanagement? The units are fine. We just got to start upping the rent. Where has that land? 50-50?
There's usually actually a combination of both in every asset. So we could actually renew or lease classic units for a higher rate than the prior owner was renting it. And we could also renovate those units and get an even greater return on those dollars. So it's usually a little bit of both, an as-is rent bump and then a renovated rent bump. But in terms of like buying a property that we didn't have to do any renovations to at all, and it was just under rented as it is, maybe 2 of our assets out of 17, usually we can't hit the return targets that we are aiming for unless there's also that bigger, juicier meat on the bone of being able to renovate.
Yeah, and I had a property manager in here, Mark, a couple weeks ago, and we were talking about the expectation of renters now is higher and it's more competitive. So you kind of have to bring, if you expect that premium rent, the product's got to be premium. Mm-hmm. It's got to feel like it's renovated and fixed up and all that kind of stuff. So that's pretty in line with what we're hearing in the single family space as well, as the expectations. Everybody's watching HGTV and they want to feel a little bit of that. They want to feel, it doesn't matter the class of property. People still want to feel like they're in a clean space that's, nice. So, okay. So continue on. So number 1, fix up the property.
Right.
What are some other ways to drive?
Rents, because
drive the rents up.
In multifamily, income is always double what your expenses are. So typically we say a 50% expense ratio. So the bang for your buck or the impact on your NOI by driving income is going to be much greater than by trying to cut expenses. Not that we don't we obviously try to make sure we're getting the best, negotiate those vendor contracts, try to do the best we can in that area, but income's where it's at.
If you need a 2x4, it's going to be, pretty much the same price. You're not knocking $1 off the 2x4.
Yeah.
You need a 2x4, you buy it for whatever they're selling it for.
And you want to provide a good experience for your tenants too. So one mistake I see some operators make is, well, I'm just going to run this deal way leaner than the last guy. I'm going to cut payroll. I don't need this maintenance guy 40 hours. I only need him 30 hours or whatever. Don't start cutting too much on the expense side because it's going to cost you more in the long run. So it's kind of a little off topic because I was going down the income path, but while I'm on it, that's another way we drive value is really just providing that top-notch customer service and make sure that our property management is on point and that maintenance is going to be there quickly, going to take care of the problem, going to follow up and make sure the resident's happy. Like, keep those residents happy, and that's a value add in itself because that means, from a financial standpoint, less turnover. Resident retention is super important because less turnover means less unit turn expenses, which means higher NOI. Yeah. So that's another one of our big focuses is making sure.
And it goes back to your initial thing that you learned in the electronics company, reputation. Exactly.
That's property reputation. Yeah, we mentioned that earlier. So, yeah, that's so important from even an economic standpoint. You want to make sure that your tenants are happy and want to stay. Makes a big difference down the line. Unit turn expenses are huge. So back to the income train of thought there. So rents is number one, obviously, but then you've also got all these other income items. And this is highly specific on the area the property is in on what we would do here. There's not really one right answer because residents in different submarkets value different things. But I'll give an example. Our Hoover property for Inner Highland Park, we have both of those we consider like A areas. Both of those we have valet trash. So valet trash is where we contract a company that provides containers for each resident. The residents put their trash in those containers on trash days. I think it's like every day, actually, like Monday through Friday, that they'll come pick it up. And then that company picks up the trash at their door, disposes of it, puts their container back. Something small like that, it generates income for us because the rate at which per unit that we were paying that company that does the valet trash is a lower rate than we're charging the residents for that service. So we generate income that way, but the residents also value that because as more A-class tenants, they don't want to walk to a dumpster. They don't want to worry about trash on, you know how dumpsters are at apartment complexes, I'm sure, when you drive by and you're like, whoa.
Yeah.
More of your like C-class apartments especially, their tenants are bad about just they miss the trash, they miss the dumpster. Yeah, they're like, oh well. Yeah. So tenants don't want to see that. They don't want to see a trashy property. So that's just one example, but that valet trash, it's a win-win because it generates income for us, and those types of residents view it as an amenity. So that's something that they enjoy and they like.
I found, too, that, when people budget things, as soon as that's like a cost that's already in their, like, process of bills, like, kind of goes away of just like, that's just life, like right. That's why even like, storage units kind of are a great space to live in because like once you set up a storage unit and it's just sitting there, it's kind of like, it's a bill and I don't have time to get it. You forget about it. And then you just keep getting rent and the stuff's just sitting there. I mean, I've got a buddy who's like got 3, they kind of downsize in their space, but they have 3 storage units right now, which is almost a whole nother mortgage. And he knows he needs to get in there and kind of minimize and probably get it down to 1 unit, but he just doesn't have the time. And so it's just kind of now it's a monthly cost that he's just used to. And it may be another year before he gets to that project. And so the same way, it's like, trash is just part of it. And then it's almost like, that's just part of rent. It's not a big deal. And you just move on and it just becomes this extra income for you that wasn't in the initial advertisement of like this unit's $1,200, but then there's like 2 or 3 other line items of like if you want all these amenities, yes, they're upcharges.
Right.
What are some other income items that you've found have worked in your properties?
Yeah, so we also do a renter's insurance similar to the model of valet trash, where we have a company that provides it in bulk to us per unit at a lower rate than what we then charge residents per unit. So once again, kind of a win-win. They don't have to worry about it, but we profit on it. So like you said, once it's kind of a recurring bill, they don't think much about it. And it also protects our property. So that's another one. All the typical ones like your late fees and your pet fees and your pet rent. We really just make sure we stay on top of those things. On the pet topic, we try to make our property as pet friendly as possible. If there's room, anytime we buy a property, we budget for a dog park. So we'll install a dog park just to mark it as pet friendly. We've got this dog park for you. We've got the little pickup stations, the pet pickup stations, the pet waste. So the non-refundable pet fee up front and then recurring pet rent, that adds up if you really try to target that type of
because not every place does that,
right.
Yeah. Or it's like, oh, I love my dog and this place has a dog park, this place doesn't.
Yes.
Which one are you going to go to?
Right.
And a subsequent thing I thought too is like a pet who can get out and play is going to tear up that property a little less because they're getting their energy out.
Right.
Like a pent up puppy, unfortunately.
Yeah, and I think you'll see a
awesome.
lot of landlords that are against pets because they think the damage they do to the property is greater than anything you'll gain from it. But and maybe that's true on like one single family home, but if you have a larger data set, you're always going to come out ahead by taking pets. Because, there's going to be more damage, but there's going to be a lot more income that offsets the damage and then some. You come out ahead. So that's what we've found. That's one way we drive.
Well, and I think for the most part, there's good pet owners, especially in a higher class property. Almost some of them treat them like they're better children,
Yeah.
So that's like a factor, but I also think, like you said, you're making the amenities, you're drawing in that type of client, and that it almost becomes a culture of like we all take care of our pets, and we all and I love on these other expenses. Yes, y'all are profiting as you should, but you're still looking at it from how does this benefit everybody? Because you're not just like it's not a one-sided like. We're the company, we're getting everything. It's all about upcharging. It's like, no, is this a benefit that makes things easier, better for our clients, our tenants? Mm-hmm. And if so, then it's a win-win. We're going to have to charge for the service. But if it's not a benefit, I'm sure there's certain things that you're like, we're not doing because it's not an overall cost benefit to the tenant.
Right. Yeah, we always look for those win-win type situations where the tenants value it and we value it because if they were to go out and get some of these things on their own, it would cost more than the price we're giving to them. So we both benefit in that case for sure. Another thing I just thought of that we try to do is revenue share agreements with internet providers. So this doesn't affect the tenant at all. It doesn't force anything on the tenant. But what we would do is when we sign a lease, we would provide them with, well, here is, Spectrum's contact info if you want to call and get internet set up. Here you go. If they do, then we get a certain percentage revenue share of their recurring bill. And that's just agreements we would have negotiated with Spectrum or with AT&T. They both do it, depending on the area.
Gotcha.
So that's just like a no-brainer. If we can get those agreements negotiated, it's free money to us because if they don't want internet at all or they don't sign up, we just don't get anything. And if they do, then we get, a recurring percentage of that every month as income.
That's awesome. Any other income producing, things that you found along the way?
There's a ton of little things, but I think that's probably hit the main ones.
What about laundromats if there aren't in units? Are laundromats at any of your places?
So we have a few, and that is another income item, but it's not one of the main ones. Mm-hmm. We collect the coins, and we typically would have a contract. I'm trying to think if we own the machines at any properties. I think all the ones we have now are actually the machines are owned by a third-party company, and we have an agreement with them where we split all the laundry income 50-50, but they maintain the machine. So it's like no expense to us, but we get some income from it.
I love that. That's such a who, not how solution. Because you're like, I'm not in the laundromat business. We're not in that business. But we can still get some profit. We don't have to have all of it. Mm-hmm. And we can outsource, laundry.
Yeah.
We'll let you do it,
and
when
it
breaks.
takes out that risk of, we had 2 machines go out this week. Now we got to go buy new ones. Like, you handle it, third-party company.
You guys take care of it. Man, that is so good. I think there's so many nuggets, and we've deep dived into, basically, the scope that's going to increase the value of the property. So continue on parts of your role. So you're managing the asset, you're lining up these agreements with, companies for, garbage and for internet and all that kind of stuff. What other stuff do you tackle in your space?
So I'm trying to remember where I left off with this when we talked about it a minute ago, I think I'd already said I handle all the distributions for investors, right?
Right.
I also handle all the lender construction draws. So even though I don't have like a hands-on construction management role anymore, I am the one that handles the financial aspect of that. So like putting together the invoices and making sure that we receive the money in a timely manner from our lenders and just kind of tracking where we're at in that process and how much is remaining. So I do that piece. I put together, so every month I put together what I call a performance report for every asset. So what I'll do is I have on the left-hand side like a budget versus actuals, and this is just financials side by side, like our initial underwriting before we bought the asset. What did we project for this month, this year, this point in time? We're very granular with our modeling. So I'll have
and are we there?
I'll have the budget, and then I'll have actually what happened, and then notes on like this is high because of this, or this is low because of this, or and then I have the KPIs we track in the top right corner. We'll track the physical occupancy of each asset, the leased occupancy, which takes into account pre-leases, net occupancy, which takes into account pre-leases and notice to vacates over the next 60 days. And then I'll track, what percent were renovated, how many units, percentage-wise we have renovated to date, how much construction funds are remaining. There's a little graph that charts our budget versus actuals, and
everybody
I'll have a
loves
summary.
a good graph.
Yeah, I mean it's a good visual. You don't have to read if you don't want to read all the little notes. You can just look at the graph and see exactly how the property is trending, not only from a net operating income standpoint, but it also breaks it down into expenses and income. So you can see, well, if our NOI is off, why? Is our expenses too high, or is income too low, or both? So once I get that report done, at that point I would send that to Stuart, which handles, he does a little bit of everything, but investor relations is one of his roles. So he would take those reports and put together like a narrative, like a just monthly update for our investors or partners. So that's another role I do, and that's monthly.
So on that, I mean, I think tracking data is very important. Like we use Traction for my team, and we basically have key metrics that we say, like, this is how much is coming in, this is how many leads we have, all that kind of stuff. So you can't know where you're going without tracking data.
Right.
How do you guys navigate when that data comes in, pivots? Because sometimes the market, can be finicky. And 1 month can be just kind of, you could have had like 5 vacancies just as a fluke.
Right.
And then all of a sudden be like, oh no, Westmore is going down. Like it's the end of the world. Or do you guys more like, hey, this is the monthly, let's keep an eye on this metric and see if it's a trend. Because if you get 5 vacancies and then 5 vacancies and then 5 vacancies, you could be like, hey, what's going on here? This property should not be that much vacancies. Why are people moving out? And then you find out there was a crazy neighbor, or whatever it is, right? So what is that reaction time to the data for you guys?
Yeah, so we really have to stay on top of the reasons the data is what it is. So weekly, our property manager puts together what we call a weekly flash report. So it has all those KPIs for every property, and it has averages across the portfolio, and we're constantly tracking that versus our goal. So what we'll do is like any property that's kind of like red flagging based on what we're seeing. So like maybe like the bottom, we can sort it, in the bottom, say the bottom 2 or 3. We're like, okay, why is that lower than we've seen historically? What's the reason? Let's dig in. So that's when we'll have those conversations on, like you said, is it a neighbor running everyone off? Like if it's a vacancy problem, then we need to dig into why. Is it a sub-market problem, or is it a property problem, or is it a fluke? One of the 3 things. Sometimes it's a fluke, and usually if that's the case, we just look at data on why did each resident leave. Well, this one bought a house. This one got transferred to a different state for a job. This one, well, maybe it's just a fluke that just so happened to all hit at one time.
The stars aligned, and I'm out a lot of money right now. So, okay, so when we were talking offline and initially about having you on here, we talking about vacancies. We talked about evictions and how, through COVID and different things, the market is telling you evictions are timelines, all that kind of stuff. Dive into some of the data that you guys have found, because, someone who owns, 10 units may go through an eviction, hopefully not ever, but maybe once a year or maybe for a few years. Mm-hmm. Over the 500 units, you have a data set, and in different counties and different cities. So talk through some of that eviction, process and kind of what you're seeing currently now with the evictions in the greater Birmingham area.
Yeah, so up until 2 years ago, I could say we didn't have a single eviction, which no one could believe at that time. Like, with the unit count we had even then, historically speaking or statistically speaking, we should have had an eviction.
Yeah.
But our management's really good at like talking out residents rather than having to go through formal evictions. The market has softened for sure. We can get into some of that data if you want to after this topic. But with the softening market, we have had an increase in evictions. We have had an increase in delinquency. We've really had to pivot a bit with just our whole plan on how to handle delinquent residents. And we've become a lot more strict on that. Now, I will say Jefferson County is by far the worst in terms of timeline and just getting through an eviction. So most recent evictions we had were right around a 6-month period for Jefferson County, which is crazy. It used to be 2 months. 2 years ago, it would have been like a 2-month turnaround. So obviously that makes us think twice before we file, because why don't we just do cash for keys? We can get them out a lot sooner.
And a lot cheaper.
Right, yeah. We have that unit back faster and can release it. So we are really taking it on a property-by-property basis now. The Jefferson County ones, we're not as fast to file. We're trying to either talk them out or cash for keys. But then in some of the other counties we own in, we have a lot firmer eviction policy. Like, we send a 7-day. You don't pay during that 7-day window. We file eviction. If you want out of it, you can pay us everything you owe plus our attorney cost, and we'll stop. And we have that happen sometimes. But we found that more firm eviction policy works well because they realize we're not playing. Like they have to prioritize rent over all their other bills. Just can't do that in Jefferson.
Yeah, unfortunately.
Oh, I hope it gets better.
And you were talking about, too, that the city specifically also plays a part. So there's, in certain cities, it's probably a full max 6-9 months, but in other cities, it might be 4 months. It's all long in general because it still has to go through Jeffco. But then as soon as it goes from there, it goes to the actual city police department. Mm-hmm. And so certain areas might have longer police department wait lines for that trash out than.
Yeah, so actually getting to a court date isn't the problem. Like you said, it's the officers have such a long list of set outs. They just can't, they don't have the manpower to get to all of them. So it is very regional. And your areas that have higher eviction rates, like say, take a Bessemer, for example. You're going to have a lot more evictions in Bessemer than you are in Vestavia. Right. So that officer's list is way longer, and he has to work through a lot more. So, an eviction in Bessemer might take 9 months, whereas an eviction in Vestavia may take 4 months. So it is very sub-market specific, even within Jefferson County. So we're also trying to take all that into account with our decisions on whether to file or try some other creative strategy to get them out.
But overall, all evictions are longer.
In Jefferson, yeah. In some other markets, we're still getting them out in 45 days, but definitely Jefferson is. Whew.
Yeah. It's fun.
Yeah.
So talk about the market, what you're seeing, the softening, kind of where prices are at for multifamily and what you were buying 2 years ago and where you're buying it now, and just kind of what you're seeing.
Yeah, so I would put the height or the peak of the multifamily market in Birmingham right around Q1 of 2022. So the last 2 years has been interesting.
Yeah. That was when money was still kind of cheap.
Yeah, exactly, yeah. Yeah, money was cheap and plentiful. Capital was not a problem. Debt wasn't a problem. Equity wasn't a problem. Yeah, very different time. So I would say that was the peak. Since then, there's been a lot of changes, and we're constantly tracking. I think, if you look at the economic data, a lot of people will tell you that we're not in a recession. The jobs market is strong. CPI is strong. All these things. But at least on the commercial multifamily side, we are definitely in some type of correction or whatever you want to call it. So, yeah, we've definitely seen a softening there. The other problem we've seen, and this is very submarket specific, is a lot of new supply coming online, especially in the downtown area. So I know over the last 12 months, there's been about 1,400 units delivered in the downtown Birmingham area, which, to put that into perspective, it's about double what you would expect to see over like a 5 to 10 year average for Birmingham.
Do you know the total amount of units that are in Birmingham roughly, like downtown area?
So somewhere around 9,000 units or so. So
they onlined almost 10% or over 10%.
Yeah, so I know I can give you 23 and 24 numbers. Now the 12-month number I gave you is kind of, part of 24 and 23, but so I know 2023 alone represented around 7% of the total downtown Birmingham supply. So like what came online was 7% of the total. And then in 24, units that are expected to be delivered is another like 8%.
Oh, wow.
So it is a ton of, we just haven't seen that in Birmingham. We haven't seen that construction boom in the multifamily space until these last couple of years. Well, that affects the leasing market, even for C-class assets in that submarket. Doesn't really affect outlying areas, but like we have that Highland Park asset I mentioned in downtown area, and that one's definitely been affected by that softening.
Yeah, it's just the demand is lower, right?
Yeah, because you've got all this new supply, and some people will say, well, that shouldn't affect C-class because you've got A-class units coming online at 2,000 plus rents. That should, but there's a trickle down for sure. So like you take that A-class, for example, maybe their rents are 2,000 a unit, but if they're offering 2 months free just to get someone to move in, and that's very common with new developments. There's usually heavy concessions because you have to lease 100 units at one time, so they'll do whatever they can.
You got to get the momentum going.
Yeah. And then on renewals,
some money is better than zero money.
Right. Well, then on renewals the next year, then they'll bring those rents up or they'll take away the concession or whatever. But those concessions, if you take it over a 12-month lease, divide it up by 12, the rents really aren't 2,000. Residents are smart. They know that. And they're like, oh, I can move over here with this brand new built with A-class amenities and quartz counters and all this. Why would I live over here for only $100 less a month? So you do lose a certain percentage of like your resident potential, base there. And then also just the overall, you have more units to absorb than you have bodies. It takes time to absorb. There's only a certain absorption that Birmingham can even take. Like there's only so many units that can be filled a month. Mm-hmm. So it just takes time for that to happen. I'm still very bullish on downtown Birmingham in general.
I would agree, yeah.
And I know our asset in that area is going to do great long term. It's really just a short term pain, and we have to change a few things in the meantime.
I've said this on several different episodes, and, Birmingham is unique in the sense that there are pockets of revitalization in whether there's pockets of really good restaurants and retail or whatever it is. But there's no you go to some cities, like I'm originally from Colorado, and Denver has like 16th Street Mall. And so there's kind of this central hub of retail and restaurants that every kind of thing centers around, and everything's kind of goes out from there, and the stadiums and all that kind of stuff. But you could ask pretty much anybody and be like, hey, what are the revitalized areas of downtown? And you could probably name off like 10 pockets of like really cool spots to be in, but they don't connect yet.
Right.
And I think downtown was so expansive in its, heyday of a lot of industrial. And there was a lot of people that lived closer into downtown. We're seeing a resurgence of people coming back to wanting to be more central. But we're still very much in the transition of those pockets all connecting. And it'll be interesting to see what becomes the main thoroughfare, the main. It could be around where the stadium's at, I'm not sure, and City Walk. That could become the hub. But there's not a lot of retail. It's a cool place to walk and all that kind of stuff, but there's not a lot of retail there. There's not a lot of restaurants.
Yeah.
So unless you're there for the event, for the BJCC. So anyway, what is your take on the downtown, with all these pockets and units coming online? Why are you bullish on the long term of it in your data sets that you've been looking at?
Yeah, just like you said, watching it change and grow over the years, and it's going to be interesting to see all those pockets start connecting. Long term, I think investing in Birmingham is a great idea. Short term is where if you're underwriting a multifamily deal in that area, you just have to be aware of all that new supply. And the Huntsville market's the same way. Both of those markets right now are just, you have to be careful. I was actually looking at a CoStar report a couple of days ago, looking at rent growth or rent declines in each submarket in Birmingham. I like to keep up on that data at least quarterly or so. But that downtown Birmingham market had declined year over year. The rents had declined 2.3%, whereas pretty much every other submarket there had been at least small gains, if not big gains. Wide spectrum there.
Wow.
But those rent declines were a result of the new supply. Concessions went up, rents went down.
Yeah.
But it's temporary. So, like I said, it's really just a temporary cash flow consideration that has to be made, not really a long-term value problem. The value, it's actually going to help from a long-term valuation standpoint.
Yeah, because then effectively it's like everybody's jumping in and it'll all create this thriving pocket of downtown Birmingham, but it's just not right now. There's competition. But I think one of the hubs of our city is the culinary. We have a lot of really good restaurants. It's almost to the fault because I don't know if you ever seen like a new restaurant open. Excuse me, but like if a new restaurant opens and it's not good, the word gets out and it's closed within like 3 months. It's like Birmingham residents like don't play. Like if the food's not good, service not good, like because we have so many good options that are not like chains. You know what I'm saying?
It really is a foodie market.
It is. And you got UAB that's driving that. Obviously, you have the new stadium that's helping propel jobs and also events. There was a motocross / like monster truck event there this last weekend. So there is a lot of really exciting things. But I agree, we are still in the metamorphosis of what downtown's going to look like in the economy and all that kind of stuff. But it's exciting to see that because when I first moved here, I mean, it was nowhere near where it's even at now.
Right.
And I imagine in another 10 years, it's going to look very, very different. So there's been a lot of progress.
Yeah.
So let's circle back a little bit about debt. We were talking about how that has changed. Obviously rates have changed. I don't know if you've been under
I'm aware.
You're aware. You look at rates every day, right? So it brings the affordability of assets. You have to navigate it. And I'm sure when, mortgages or commercial debt was, in the 3s and 4s and 5s, you guys were underwriting and going to different sources than you are now. So talk about kind of that journey over the last 2 years of debt you've taken on and where you've gone to it and where you're at now.
Yeah, so it's definitely changed a lot for us with the changing market. I think before I jump into how we've changed, just want to make sure people kind of have a basis of the 3 main types of debt. So in multifamily, you've either got local bank debt or credit union debt. You've got agency debt, which is your Fannie Freddie multifamily loans. And then you've got bridge debt, which we've never messed with. And it's a more risky type of debt, and I'm glad we've never done it. But between agency debt and bank debt, up until 2 years ago, we almost exclusively went bank debt. It actually was a competitive edge for us at the time because we had these local lenders, and myself being local, a lot of times these lenders won't work with out-of-state investors. So it cut out a lot of those competitors. But our local lenders were able to offer us very attractive construction loans where they'd wrap in the construction funds into the loan, like 80% loan to cost. The rates were lower than agency at that point in time, at least for us because we had the relationship. I don't know if it'd be true for everybody. But that would give us a competitive edge because of that construction loan ability, the leverage we were able to achieve, the rate. And then also there was no prepayment penalty with those loans. So that gave us full flexibility on the exit, which we loved.
Is that normal for them to offer no prepayment penalties?
For our lenders, yes. I don't
You're
know
like,
about
when I
every
roll
lender.
In, I tell them the terms, okay?
We spent a lot of time making those calls and forming those relationships
Yeah.
to find the lenders that offer the terms we needed. So I can't
Yeah.
say it's true for every local bank in Birmingham, but at least the ones that we were mainly closing with, that was the case. So, but what I found is that when the market is hot, so early 2022 or before, those local bank lenders were most aggressive. Like, they would give you the best rates, the best terms. They wanted your business. And then when rates started rising, they were actually slow at first to rise rates too, which is weird. I haven't really figured out why.
I noticed that.
Did you?
Yeah, I would.
It's not just me then.
No. I had a deal. I was working on a 17-door single family deal, but it's still commercial debt. And the quotes I was getting from one local bank that was a credit union, I was like, how are you still all at like 6%? Everywhere else I'm at like getting quotes at 8%. Now, that local bank, which honestly, I wouldn't call it a deal breaker, but it definitely hurt the deal. They just did not want to take the risk of the asset class that I was like presenting, and just kind of their nuances. I was trying to buy a commercial unit with some single family. So there's a little bit of like mixing classes, and they didn't feel comfortable. But all that to say, yeah, their quotes, I was like, please just approve this, like, because they were 2 points lower than other places I was getting quoted. So, so they were lagging in their rates.
Yeah, which is crazy. But it helped us even through the end of 22.
Right.
Because your out-of-state investors would come in and try to use agency debt, and we were able to be more competitive with local debt at that point. So it worked out for us. But then what we've also noticed is as rates are falling, which I know the Fed hasn't actually cut rates yet, but the treasuries have dropped, because of that anticipation of rate cuts this year. As rates are falling or as treasuries are falling, the local banks haven't been as fast to drop. Now their rates are higher than the agency debt. So now we've had to shift. And now we are underwriting most new opportunities with agency debt, which means for us much lower leverage. We're not able to wrap construction into the loan. So it means a much larger check, to close. So what might have been a $2 million raise for us to close a deal previously is now more like a 4 or a 4.5.
Wow.
So that's the downside to that, but we are able to be more competitive than local banks by using agency debt just because the rate's lower. We're able to get that 30-year AM versus the 2025 that local banks offer. And we're also able to get additional years of interest only, which is helpful if we're repositioning.
Yeah.
So we are looking more towards agency debt now, as long as the
Are
property
there
qualifies.
payoff penalties?
There are. There are prepayment penalties, so we have to be very careful that we're modeling for that correctly. We just have to make sure, like Jeremy's our acquisitions guy, our acquisitions partner, and he has actually a tab in our underwriting model for a yield maintenance prepay calculation. So he charts all this out and tries to more fine tune like exactly what it's a lot of guesswork, but we want to make sure that we can estimate it to the best of our ability and then underwrite for that, put in that prepay on the exit to make sure we're accounting for it.
Man, that's there's a deep dive there. Yeah. I don't know if we have time on the modeling.
You may not want to know all that.
Yeah.
You're going to go to sleep if I tell you all of that stuff.
Yeah, no, I mean, it was interesting. I've got a buddy I do talk with a decent amount, and he is in the multifamily space. And I'm trying to learn it. I want to grow, and but I've looked at some of the modeling, some of the underwriting stuff, and my sheets for a lot of the space that I play in, they're not complex, but they're also not overly simple. But it's at a totally different, place with watersheds and like if we do this is all happening. How fast do we renovate the units? Yeah. And I mean, it really is a, in some ways I think it's interesting because it still is real estate, right? But then in other ways you're just dealing with very complex things. And I found that when I talk with people who are successful in the space, they have a team. It's not just one person. They're always collaborating for raising money, acquisitions, people who are keeping the properties, the management of the asset like you do. So I think it's incredible that you have found a team. I think it's like, honestly, probably one of those things that you probably realize how lucky you are that you found other players in the space that you trust and can work with and kind of all complement each other. So that's incredible. as you move forward, where do you guys see yourself going in markets? Where do you guys see yourself going in opportunities? Is there any pivots into different types of classes, like maybe get into industrial or get into self-storage, or y'all going to stay honed in on multifamily? What's the future of Astra?
So right now we're definitely staying honed in on multifamily. I don't foresee that changing ever, really, unless there's a compelling reason to. I think it's wise to stick with what we know. We now have that experience to where we're very confident. When underwriting a new deal, we can look at historicals of past deals, and I just feel like going into a completely new asset class, there's so much, we don't know what we don't know, and it's too much risk there for me right now. So I think we're staying exclusively multifamily. In terms of markets, like I said, everything we own is in Alabama today, but we actually do have an asset under contract in Mississippi right now. So
congratulations.
We're expanding. Thank you. We're expanding over into some of those markets. Very selective about where in Mississippi.
Yeah.
There's really only like 3 submarkets we're even interested in there.
Right.
But I'm from Mississippi originally, know the market really well. So that's something that, may not, hopefully it's not our last asset. It's our first, but hopefully not our last. We'll continue to look there as well. In terms of size, we're definitely hoping now that competition is not quite as fierce as it was a few years ago. We're hoping to acquire more in the 100-plus unit space. Those assets are just easier from a management standpoint because we can have full-time, it supports full-time on-site management and maintenance. So the asset we have under contract is an 100-plus unit, and we hope to acquire more of those as well. But otherwise, we're just seeing where this takes us. We're not like some people that's like, I have a unit count goal of whatever for this year. I feel like sometimes that, at least for me, could make me want to buy a deal that doesn't make sense to meet a goal. Or I think for Astra, if the deal makes sense, we buy it. And if it doesn't, we don't. And if that means no deals, fine. If that means 10 deals, great. So we're just kind of seeing where this thing takes us and hoping to continue growing at a steady pace, but a smart, slow pace as well. We want to make sure that we're giving all of our assets the attention they need as we're growing too.
Yeah, I think that's, not to say moving into new is great and pushing yourself is great, but you also maintaining what you have is super important. And I think that's a lot of wisdom in that. Yeah. So if somebody wants to kind of build a relationship, get a hold of you, maybe eventually invest in some of y'all's opportunities, how do they go about that?
Yeah, so we do take investor partners, in which case they would own a percentage of the LLC that the property, that holds deed to the property and would get distributions quarterly. Now, based on SEC rules, if anyone contacts me, I wouldn't be able to have them invest in a deal we're currently working on, but I'd love to get that relationship started for future deals. So if you are interested in investing, or if you just want to chat multifamily, if I can help in any way.
Look at some data sheets, which
hey,
you love.
I love talking about that stuff. So you can email me at Candace, Candace, at Astra, ASTRAEQ.com. So EQ as in equity, .com. Or you can also go to our website at AstraEQ.com. And there's a investor portal tab you can click and sign up that way, which would then send us a message to where we'll set up a call with you because we definitely want to learn more about you.
That's awesome.
But please reach out to me. I love talking about Birmingham or Alabama multifamily in general and would love to connect.
Yeah, no, I love that. And thanks so much for taking the time. I mean, I think there are so many different nuggets about Birmingham specifically, what we're doing with evictions, the downtown area. I had no idea that we were I don't want to use the word saturated, like oversaturated, but definitely when those bursts of buildings come online, you think about in holding pattern of buildings like being worked on, and then all of a sudden it's ready. And I mean, you could have 50 units go online like that, and then that happens 4 or 5 times, 100 units, another 50, another 25, and then all of a sudden. So to have that 1,400 units in that year time span, I mean, that's a lot. And so I had never heard that data. And to me, that's one of the nuggets of this conversation is to be if I'm a single family investor and I'm oh, I love the downtown area. There's a duplex right around the corner that I want to renovate and fully furnish and do all these, I have these dreams, right? Well, the data says that if I don't have, not to say don't do the deal, long term, great job, great opportunity.
Right.
Short term, if you don't have the cash, your expectations on rent may be a little bit ambitious in this current market. Right. That point alone, and that's what I'm trying to bring with this podcast, that point alone is worth the listen. And so the value you have brought is just incredible. And I just thank you for your time. I know that we tapped into probably 10% of your knowledge. So, I might have to have you back on and we'll deep dive in another part of, the multifamily space. But thank you so much for taking the time to, just share with people that listen about Birmingham and multifamily, and just super grateful. So
yeah, absolutely. I loved being here. Like I told you on the phone, prior. I think it's super cool what you're doing here. I love that it's a Birmingham specific podcast and you're really just getting into the weeds and not just high level. So I really appreciate the invite. It was fun.
Awesome. We'll do it again.
Yeah, sure. Yeah.
All right. See you later.
All right.